This is a recording about the currency derivatives that is covered in Chapter 7. So I will try to provide a little bit of a background by going through the chapter and exercises. So instead of lecturing about the core concepts, I will go through the examples and revisit some of the basic concepts that are referred to in these questions. So before we go deep, I just want to go through this table where we have Chicago Mercantile Exchange FX futures contracts. As you see, there are multitudes of contracts on a range of currencies, from Australian dollar to Hungarian forint in here. Although these contracts do exist, they are not all liquid contracts. This means that there are not much trading happening in some of these contracts, but some of them are highly active, like euro, like the pound contract, Japanese yen contract. But some of the emerging market currencies probably are thinly traded in this market. Each of these contracts are priced in US dollars, and the underlying is the currency that you see in this column. For instance, for the Australian dollar contract, the underlying is the Australian dollar. The contract includes 100,000 units of Australian dollars, and the pricing of the futures contract is the dollar or US dollar per Australian dollar. And in order to find out the face value of the contract, you need to multiply the unit price of the contract with the number of units within the contract. Similarly, Brazilian real contract is composed of 100,000 Brazilian reals. The Japanese yen contract typically is composed of 12.5 million Japanese yen. Euro contract is composed of 125,000 euros. Mexican peso contract is composed of 500,000 Mexican pesos, and so on. So each of these contracts can be traded for the amounts that are multiples of these amounts. For instance, you cannot buy or sell a futures contract for 50,000 Australian dollars. You can either buy or sell for 100,000 Australian dollars, or 200 or 300, so multiples of these 100,000. There are a few what we call cross-rate futures. In these contracts, euro is the underlying. For instance, this particular contract, which is a pound-euro contract, the underlying is euro, but it is priced in pounds. Another one, Japanese yen euro, the underlying is euro, but the contract is priced in Japanese yen. And the third one is a Swiss franc euro contract, where the underlying is euro, but the contract is priced in Swiss francs. So the norm in the futures markets is that the contract is priced in US dollars, and there is an underlying currency where the contract is composed of, and usually this is ranging from 100,000 units to, as in the case of this Hungarian forint, for instance, 30 million units. Each of these contracts have specific maturity dates. Usually they do have quarterly cycles, and there are nearby months where the contracts are also traded. So usually each contract expires in the month that we are in, and then there are two adjacent months, and then we do have a quarterly expiration cycle for each contract. For those specifics, the best way is just to go and check the CME website, where you can find out the specific contract expiration dates. Here's an example. I just pulled this up from the CME website. This is the information about Euro futures. At the date that I looked at it, which is on July 3rd, the price per unit euro was $1.17175. As you can see in here, the contract expiration months are March, June, September, and December. These have some codes like HMUZ. Each contract is 425,000 euros. The trading volume for this contract for that particular date was 160,020 contracts. So we can go forward, and here again, this is another screenshot from the CME website. Each contract has a code like 6E, implying Euro FX contract. The Canadian dollar contract is 6C, which is the code, and again, for each contract you can find further details about the expiration, the size within the contract, and so on. They do publish this, what they call FX heat map. Green implies increases in prices, and red implies declines in prices. The lighter red implies larger increases in contract prices. The lighter red implies larger declines in the contract prices. So for each of these contracts, the US dollar price of each of these currencies has increased. As a result, we have greens in each of these contracts. The largest increase occurred in the Mexican peso in dollar terms, so it went up by about 2.37%. And it looks like there is a reasonable volume here for the 3,865 contracts was traded in here. This is a chart that shows contract prices. You will see a similar chart in Wall Street Journal or Financial Times. So as you see in here, we have the opening price, high during the day, low during the day, a price that is called settlement, which is actually determined by the exchange at the end of the trading day. Typically, settlement prices are determined by taking the volume-weighted average of contract prices within a particular time frame during the trading day. Usually, during the latter part of the day, probably a 30-second time frame is picked up, and the prices are volume weighted, and an average is calculated, and the contract settlement price is determined by the exchange. In this particular case, for instance, the Japanese yen contract, which has 12.5 million Japanese yen in the contract, the prices that you see in here are US cents per 100 Japanese yen. This is a peculiarity of the Japanese yen contracts. This is not the case for all of them, as I'm going to show in a little bit. For instance, in this particular case, the opening price for the Japanese yen June contract was 0.9210 cents per 100 Japanese yen. So in dollar terms, actually, this would mean 0.09210 US dollars per Japanese yen. So for convenience, the prices of Japanese yen contracts are expressed in per 100 Japanese yen. So in June, there is 159,608 contracts still outstanding. That's what actually open interest means. Open interest means that the number of contracts that are outstanding. There is a open contract that is not settled yet. So in this case, there are 159,608 of these contracts are not settled yet. So there is a buyer and seller for these contracts that are still actively in the exchange. The September contract open interest is, as you see, much lower, 1,443. Typically, the nearby months open interest are higher. As the contract expiration approaches, the open interest declines because most of the contracts are closed out. So as another example, let's look at the Canadian dollar contract in here. As you see in here, per Canadian dollar, each contract actually includes 100,000 Canadian dollars. Prices are expressed for 1 Canadian dollar in dollar terms. So June contract opening price is $0.7724 per Canadian dollar. September contract is 0.7719 per Canadian dollar. And as you've seen here, there is 118,862 open contracts that are not settled yet for June, and September contracts are 2,744. Please note that the trading volume and open interest are not the same thing. So there could be a lot larger trading volume than open interest, because as traders buy and sell, some contracts may be closed out. As a result, we might have much larger trading volume than open interest. So these are some of the peculiarities of the futures contracts. I wanted to go over some of these basics before we delve into the questions.